Watching the 3-month Treasury bill, signals of liquidity and crisis. One. Why the 3-month T-bill matters. The 3-month Treasury bill may look boring, but it's the canary in the coal mine. If its yield suddenly drops by 25 basis points in a single day, without any news, you're seeing a liquidity event. Translation: someone big is in trouble, and cash is being hoarded. This happened during the Silicon Valley Bank collapse when short-term rates moved sharply. So what does that actually mean? Trouble shows up first in the plumbing of money markets, treasury bills, commercial paper, overnight repo. Footnote: sudden unexplained moves in short-term treasuries are early warnings of liquidity stress. 2. The Fed's role. When these cracks appear, the Federal Reserve usually scrambles. Think of the Bank Term Funding Program, created to backstop banks. If repo rates spike, or if Treasury bills catch a bid and yields collapse for no reason, it signals hidden stress. The Fed often steps in, but it's like putting out kitchen fires in a house made of kindling. Footnote: Fed interventions can calm money markets but don't eliminate systemic risks. 3. The bigger market picture. Right now, bonds are acting strangely. The 10-year yield drifted up even after a Fed cut, while the 30-year rallied before the announcement. Stocks are hitting highs, but the rally is concentrated in a handful of AI giants. The broader market, measured by thousands of stocks, isn't back to its 2022 peak. That's a bubble warning. When the top 7 names carry the index, it's like balancing an elephant on a bar stool. Footnote: narrow market leadership often signals fragile and unsustainable rallies. 4. Housing and stocks, the two-headed risk. A housing downturn is already underway. Builders are reporting the worst margins in over a decade. Incentives are disappearing, which means posted home prices will finally fall to reality. Housing cycles historically run about 18 years, and we're at the downslope. Couple that with stock valuations at absurd levels, and you have two bubbles ready to deflate together. Like 2007 all over again. Footnote: housing weakness plus overvalued equities creates amplified recession risk. 5. Inflation versus deflation tug-of-war. Here's the confusion. On the surface, inflation looks sticky. But housing, which is 40% of CPI, is trending down. That means headline inflation may dip below 2% within months. Yes, you might see a few hot months of data, but the underlying force is deflation once housing cracks fully. So what does that actually mean? Rate cuts won't save stocks. They'll just confirm the economy is already sliding. Footnote: falling housing costs will likely drive disinflation, despite short-term inflation scares. 6. Gold, oil, and other signals. Gold is sending multiple signals: anticipation of money printing, hedging against global instability, and its slow return as a monetary anchor. Central banks are accumulating, expecting it to play a role in any future currency system. Oil, meanwhile, is cheap in real terms. It reflects weak global demand, though any war flare-up could spike prices. If oil surges past technical thresholds, it's a geopolitical alarm bell. Footnote: gold is positioning as future money, while oil reflects both weak demand and geopolitical risk. 7. Black swans and white swans. The white swan is obvious, a housing and stock market correction visible in the data. The black swans are scarier. A war over Taiwan, India-Pakistan tensions, or the yen-carry trade finally imploding. Japan faces an impossible choice: save its currency or save its economy. Either decision could set off global ripples. Predicting the timing is impossible, but ignoring it is reckless. Footnote: known risks, white swans, are already visible, but sudden geopolitical or financial shocks, black swans, remain wildcards.